The recent collapse of Silicon Valley Bank has sparked a great debate about the security and stability of the entire banking system. With so many people's money on the line, it is essential to consider what this event means for our collective financial security. Is the entire banking system vulnerable? Is your money safe? What could you do to make sure you are best protected? Hey guys, Eric Martel here. In the last few days, we have witnessed one of the largest US bank failures in history. What makes it so much worse is that even though it might seem like an isolated event, once you begin digging deeper, you'll be concerned about the repercussions it might have on other banks, companies, and people working at these companies. We had a banking collapse in 2008, and yet here we are today. Will this bank failure escalate? Is our banking system vulnerable? Are we to expect regular bank failure? Is this the normal? Is your money safe? What could you do about this to make sure that you are best protected? So let's start talking about Silicon Valley Bank. So this company was founded in 1982, and it quickly became a prominent lender throughout Silicon Valley, while catering almost exclusively to venture capital. Essentially, SVB became the bank of choice for entrepreneurs and startups for the last several decades. That worked out incredibly well until recently. In 2020, when the interest rates were reduced to zero and stimulus packages were enacted, banks and individuals were flushed with money. Almost all of that money went back into the banking system, which is when things began to go wrong. Normally, banks operate on what's called fractional reserve banking. This means that banks are required to keep at least a percentage of their customers' money available at all times for withdrawals. Imagine that I am the bank and the reserve requirement is 10%. You give me your $1,000 to hold on to for safekeeping, but I could turn around and lend $900 of that money to somebody else who could lend $810 to somebody else, who could give $729 to the next person, and on and on and on. Banks also hope that enough people give them $1,000 deposit so that when the first person wants their money back, they'll have enough cash on hand to process that withdrawal. So if I have 1,000 customers, I would have $1 million in deposit and I would keep 10% of that in cash reserve, or $100,000. If a customer wants to withdraw their $1,000 deposit, there's plenty of money to do it. In March 2020, the Federal Reserve reduced the reserve requirement to zero, making more money available for lending and stimulating the economy. However, this added a risk that some banks would take it too far, overlend, or overinvest. The reserve requirements is there to make sure that there's enough cash in a bank to handle normal withdrawals. But that also relies on everyone having faith in the system so that not everybody wants to pull their money out at the exact same time, which has started to happen with SVB, Silicon Valley Bank. This is what's called a bank run. What happens when banks have money sitting around? Banks often take your money, loan out a portion of it, and invest the rest in really safe and stable investments like US Treasuries. As long as those securities are held to maturity, the bank gets a guaranteed return and they get their money back. Customers can be made whole and everyone wins, except in this case. In early 2021, SVB took roughly $100 billion and invested it in government-backed bonds, with a significant portion of that locked away for 3 to 4 years at an interest rate of just 1.79%. Essentially, this meant that Silicon Valley Bank took a massive bet that the Federal Reserve was not going to raise interest rates as fast as they did, and that the inflation rate would not go up as high or as quickly. When their assumptions ended up wrong, their safe investment turned out to be a very bad one. Banks are not supposed to take risks like this with depositors' funds. So let's just imagine with an example. So Silicon Valley Bank took $100 and bought a 2% interest rate bond for 4 years. 4 years later, they would receive $108.24, which is their principal plus the promised 2% interest rate compounded. But what would happen if interest rates suddenly increase right after you made your investment decision and all of a sudden you could buy the exact same $100 bond at a 7% return and make $131 over this exact same 4-year period. If you hold on to your 2% bond for the full 4 years, you would still get your principal and interest back as promised. You would just be missing out on a higher interest rate. This is important to understand because this shows that SVB was forced to sell these bonds in order to fix their liquidity issues. Now, high inflation and high interest rates also had a dramatic effect on the economy. People had a hard time paying their bills, so they had to choose between, Netflix, cable TV, or other discretionary spending so that they could pay their rent and put food on the table. I am simplifying, of course, but this caused lower revenues for many companies, especially high-tech companies. Many of these high-tech companies found themselves in a tough spot. They had lower revenue, but they still had to pay their operating expenses, so they would see their bank account go down as their withdrawals are higher and their deposits lower. Many of these high-tech companies were banking at SVB, which caused SVB to need some cash quickly. Silicon Valley Bank couldn't wait 4 years for their bonds to mature, so they decided to sell $21 billion of their underperforming bonds. In order to attract buyers, they had to lower the price, which ended up costing them $1.8 billion. Essentially, Silicon Valley banks severely misjudged the size and pace of the Federal Reserve's rate hikes, the inflation, and its impact on high-tech companies. Because they assumed that high-tech companies would continue to stay strong, that led them in a situation where they locked too much of their money away in one specific asset that yielded too low of a return. And that occurred at the exact same time that their customers began withdrawing more money than they anticipated. On March 8th, the company announced that it would sell off a third of its stock ownership. On March 9th, the word got out that the company could be potentially facing insolvency issues, and as a result, their stock price plummeted more than 60%, making it unlikely that the company would be able to raise additional capital to help plug that big loss. At that point, the entire situation turned into a full-scale panic. On the morning of March 10th, Silicon Valley Bank announced that they had failed to raise the capital, and a few hours later, Silicon Valley Bank was shut down and closed by regulators with the message that all of the bank's deposits are transferred to a new bank. Of course, you might be thinking that FDIC insurance exists for that reason, that they should be able to recover their deposits, except that FDIC insurance protects you up to the first $250,000 you have deposited in the event of a bank failure. Now, this was created after the bank run in the 1920s as a way to incentivize people to trust the banking system again. However, in this case, the bad news is that only 2.7% of Silicon Valley Bank are less than $250,000, meaning that 97% of that money is not FDIC insured, and it's not clear exactly what's going to happen to all that money. Typically, in cases where deposits exceed the FDIC limit, losses are recovered in a bankruptcy court when assets are sold off to pay their creditors. But that process could take several years to complete, and more than likely, their customers are not going to receive all of their money back. Another option would be for another bank to acquire SVB and make all depositors whole. This is not even the worst of it. This failure could reach over to other banks and other companies. SVB isn't just a bank for the average person. They are the bank for a significant portion of venture-backed companies throughout the United States. And when those businesses keep a significant portion or even all of their money with that institution, they can be completely wiped out overnight. The reality is many of these institutions have raised millions or even tens of millions of dollars with the expectation that it's going to be enough to last them for a while. From that perspective, this is going to be crippling to many businesses that bank with Silicon Valley Bank, especially since SVB currently holds more than $342 billion worth of customers' funds. If a company holds a significant portion of their funds at SVB, it could mean that the company would not be able to pay their bills, payroll, and many tech startups are relying on these funds to grow the company rapidly, which means that they spend a lot of money, and if these funds are not available, you can imagine what will happen. This is why the federal government stepped in to guarantee 100% of depositors' funds. Then the next question is, could the same thing happen to your bank? And the answer is, it's possible, but it's unlikely. The issue with SVB was that they were in a niche market servicing startups and were funded by venture capital, which was drying up. That meant that very little money was flowing in and a lot of money was flowing out of SVB. And the majority of the bank's capital was locked away in bonds for the next 4 years in a low interest rates that had declined in value. Essentially, this meant that if the bank were to wait long enough, they would have enough cash on hand to potentially absorb the short-term losses. But when everyone begins withdrawing all their money, all at the exact same time, the bank is left with no other choice but to shut down. Every single bank operates this way, but in Silicon Valley Bank's case, they went all in on the bond market at the worst possible time. When their customers started moving money out of the bank during a time where they needed capital and wanted a high return, it was really a perfect storm. Is your bank in trouble? The Fed Vice Chair recently said that there are obviously larger institutions that are exposed to these kinds of risks, but the exposure tends to be a very small part of their balance sheet. So even if they experience the same deposit outflows, they're more insulated. That's why I think in order to best protect yourself, you should never keep less than what's insured from the FDIC, which is typically $250,000 for an individual bank, or stick with one of the larger institutions who is more diversified and more likely to be okay. This is another very good example that you should never keep all your eggs in one basket. You should always have multiple accounts in good standing with other banks just as something to fall back on. And at the end of the day, sometimes things can happen that are completely outside of your control. Even if you do everything right as far as what happens next is really anybody's guess. Putting money in multiple bank accounts will only protect you from bank failures, but what will protect your money against inflation? That's why I tell my listeners to invest your money. Have your money and your equity work for you all the time. In recent years, with stock market crashes, cryptocurrencies dropping, where can you invest? My recommendations is to keep the minimal amount of cash in the bank for emergencies and invest the rest in cash flowing real estate. As you know, the federal government stepped in to prevent what could potentially be tens of thousands of employees losing their jobs and companies going under. Many people consider it a government bailout, but based on the information I have, the federal government is simply guaranteeing the depositors' funds. They're not helping the bank stay in business or helping investors who lost money. They are only assisting the depositors. Personally, I have very mixed feelings on this. First, in 2008, when banks almost collapsed the global financial system, the US government passed laws to prevent another bank crisis. In 2018, the government reversed course, stating that banks know how to regulate themselves, so we should let them do whatever they want to do. So if you're a small bank and medium-sized bank and you want to grow rapidly, you take more risk, right? And this is exactly what happened. No bank should be legally allowed to take such a sizable risk, and there should be more regulation in place to make sure that deposits are properly diversified. Second, the FDIC limit of $250,000 makes absolutely no sense to me. It is such an arbitrary number. Maybe it should be 80% of all account balance, no matter how much money you have. The move by the government to guarantee 100% of the depositors' funds is a de facto 100% guarantee of depositors' funds then, overruling the FDIC. Is it going to be like that for all the other banks that are going to fail? Are they going to help only certain depositors, certain industries, certain banks whenever they feel like it, depending on the economy? Should business accounts be fully guaranteed because they have operational expenses, overhead, payroll that supports tens or even thousands of employees? Third, let banks fail. If we don't, they will continue to make risky investments, poor business decisions, and we will be talking about another bank failure in a few months. There must be consequences. Maybe executives at failed banks should not be allowed to work in the financial industry ever again. All of this is too little, too late, and the best we could do right now is just wait and see what's going to happen. And with that said, make sure you like and subscribe. Make sure that you add me on Instagram and check out these videos. See you next week.